What's going on, guys? Welcome back to TTC, and in this video we're going to be going over why technical analysis actually works. Alright, so this is actually going to be the first video in a series of videos that we're going to be having discussing technical analysis and trading concepts very much in depth, so that if you are new to trading or if you're new to trading or don't really know anything about trading, then this is going to be the series for you. So let's get into it. So why does technical analysis actually work? The answer is actually pretty simple. The reason why technical analysis works is because of human psychology. People expect something to be a certain way, and then they would act in accordance with that belief, and then it becomes a self-fulfilling prophecy, right? So I'll give you an example. Every weekend, Friday and Saturday, those are really the days to go out, have fun, to the bar, to the club, whatever it might be, right? But why do people do that? People do that because it's kind of expected that Fridays and Saturdays are the nights to go out, right? So people think that going out on Friday and Saturday is the correct day to go out because all the other people are thinking the exact same thing. And then since people are acting in accordance with that, people are actively getting ready and going out on Fridays and Saturdays, right? It becomes a self-fulfilling prophecy. People think that there's going to be people out on Friday and Saturday, so when you go out, there are people there because everybody thought that same thought, right? It becomes a self-fulfilling prophecy. And the same can be said for technical analysis. Concepts like support and resistance, double tops and double bottoms, trading with different indicators, whatever it may be, these things work because of human psychology. Because people think that they work, the traders in the market actually execute trades and operate based off of thinking that they work in a certain way, right? So I'll give you an example of support and resistance, right? Price keeps retracing down to a certain level and reversing. Price comes back down to that level again and reverses, comes back down to that level again and reverses, right? Why does it do that? Because people think, oh, it's reversed from that area in the past, so when it gets to that area, let me buy so that it'll go back up, right? That it's a self-fulfilling prophecy. People think that one thing is going to happen, and then they act in accordance with that thing, and then that thing eventually happens. Let me leave you with one more example on this study done at the University of Leeds on herd mentality. So there was a study done at the University of Leeds in which participants were asked to walk in a large hall in random directions. Within the group of people, a select few were given information about where to walk. But the catch is that participants couldn't talk to each other, and they had to stay within arm's length of another person. They repeated this study many times with varying groups of people, varying sizes of the groups, changing up the location of the people that they're giving the detailed information to, and so on and so forth, right? So they repeated this study multiple times with a bunch of different factors, and in all cases, the study found that the informed individuals ended up being followed by the rest of the participants. Professor Krauss, the professor in charge of the study, remarks that what's interesting about this research is that our participants ended up making a consensus decision despite the fact that they weren't allowed to talk or gesture to one another. In most cases, the participants didn't realize they were being led by others. So how can we relate this to trading, right? So if you think about it, the informed individuals are the ones that were being followed in this University of Leeds study, right? But in trading, in the markets, you can think of these informed individuals as the people with a lot of money to move the market, right? So these central banks, large hedge funds, and things of that nature, right? They're the ones who have lots of money and can really influence the market if they want to, right? So let's say price is falling and they don't want price to fall below a certain level, then when price gets to a certain level, then they'll buy it so that the price will then return, right? So the example that I gave before, you can imagine that a central bank doesn't want price to fall below a certain level, right? So price is coming down to this level, so the central bank doesn't want price to dip below this level, so what do? They buy it and price goes up. Price comes back down to that area again, they buy it again, right? And then us as retail traders, we see this, we're saying to ourselves, okay, this must be an area of support. This must be an area where price doesn't really want to dip below it. So what are we going to do? We're going to buy it as well, right? So that's a simple example as to why technical analysis works, and and how it can work without us even understanding the full mechanism of really what's going on, right? So yeah, guys, that's basically the video. It's just a quick one, really explaining why technical analysis works, and from here on in the series we can build on more and more different concepts and really explain why those concepts work, right? So yeah, like the video if you did, dislike it if you didn't, leave a comment down below, subscribe to the channel, and I'll see you guys in the next one.